Just help hedge funds again, disguising it as a pounce.
No. And let me blow your mind for a second. If you look at every time AMC is run, right? And I've talked about this for so long, so fucking long. Called so many fucking different things for this opinion. Dilution is actually a really effective way to increase the price of something. You want to know why? Because here's what happens. The stock that's not doing well, it's probably going like this. During this entire sequence of events, they're bleeding money. So then what they decide to do at about this point in time is an at-the-market offering, which means that they are selling part of their company to the public so that they may essentially buy into the company, which gives the company revenue to work with. And then ideally, you obviously will drop in price, or you would think, and then use the capital acquired from this to strengthen your business fundamentally. Here's the catch, and here's what makes Wall Street even more sneaky, vile, and disgusting. What if instead your bond market went to zero? Bonds are no longer worth anything. They produce no yield because, I don't know, you print 75% of your total currency in circulation within the span of 6 months because of a virus? Okay. So instead, now you have a bunch of funds, be it pension funds, money market funds, hedge funds, all of these people who have to their strategies what is known as a fixed leg. AKA a constant income of some sort. Typically, you can get from bonds, right? But now, because the bond market is absolutely fucking raped, what do you do instead? You inflate the stock market.
Welcome to the church, motherfuckers!
Holding my few shares close. We got this, brother.
So going back to my point of you would assume that an at-the-market offering would somehow drive price down, right? Fundamentally, you would be, but technically and throughout the perils of Wall Street, what will actually happen is the price will go up. If you ever look at any time that AMC and or GameStop has done an at-the-market offering, they just so happen to go up a lot. And I'll tell you why. Because when you drive the share price up, as you're driving it up, right? How convenient would it be if the customer of the at-the-market offering was also a custodial agent? Enter BlackRock and Vanguard. Okay. If you look at the institutional ownership of these two beloved retail stocks, their institutional ownership is through the roof. So now let's take inventory real quick. What do we have going on? A dramatic increase in institutional ownership. We also have a dramatic increase in price. And we now have an opportunity. We now have an opportunity here. What's going to happen is that all of the media is going to say that this particular security is over its fundamental value. It's too, it's retail mania. It's this and that. No. Sure. Okay, so now we have a huge institutional ownership by these people. If you look at the business models to these two particular conglomerates, you will find that the majority of their revenue and profit comes from fixed income. But if you recall, a couple minutes ago, I had said that fixed income is no longer a business because the heart and soul to fixed income, bonds, don't yield anything. So how can you get around that? How can you still be one of, if not the biggest? You don't even know what to call them. There's a word that has to be made up for these people. If your primary means of revenue is no longer feasible, then what do? Well, you just make a substitute. You get creative. You inflate the stock market. So now let's do one more piece of inventory. Inflated stock market. BlackRock owns almost every ticker on the New York Stock Exchange and the NASDAQ. Look up Charlie's vids if you're not completely filled in. What they then will do is they will take all of these holdings and take them to the SLM, the securities lending market. What happens now? Well, now all of these shares are available to borrow. For interest rates or borrow fees, whatever colloquialism you want to use, that actually mimic that of a bond yield. You have an inflated stock market, and you have tons of equity on hand that you want to make fixed income with. Bring in Wall Street. The same people who are saying that the market is going for a bull run, inflation is no problem, blah, 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 blah. They're going to go and borrow all of this. They're going to take it, put it all the way back at the top. They're going to pay their APR and also take the principal / revenue of taking a stock that just squeezed and write it all the way down to the bottom. So to get back to my original point, why did we run in January and in June? Well, short interest was a factor. Another factor was at the money or at the market offerings. If you look at the dates of the Silver Lake conversions and the Wanda had sold, I think it was like a 20% stake or something. And then I still distinctly remember making the tweet saying, "You fucking idiots, you sold at the bottom," because then the stock ran 20 to 30% a couple days later. Who was purchasing Wanda's holdings? So Wall Street gets out of the way. They let the ask and the bid do their thing, drive the price up. And the CEO of Overstock, fuck. Why can I not remember his name? Patrick Byrne has gone on record officially, legally, unofficially, informally, about this particular scheme where hedge funds will use pension funds and mutual funds and money market funds as these intermediaries. So you guys serve as the custodians for all this stock. I will pay you this interest rate every month, every quarter, whatever it is. You guys be the absorbing factor here. Give us shares to short stock back down with, and we'll rinse and repeat. Look at any time either of these stocks have ran. Every time, it's when there's dilution. Dilution at the market offerings, wherever you have a bunch of equity changing hands very quickly and rapidly, that's when these things run. So they run the price up, and then they'll short it on the way down. The funds will collect their profits on that, and then the mutual funds, the pension funds, so on and so forth, the custodial agents, the custodians, will collect their fixed income. And just as a kicker, this was from BlackRock Q2 of 2019. Over 75% of their revenue comes from securities lending. So to go back to my point, fresh liquidity is what these pieces of shit want. When there's fresh liquidity, they'll let it run, and then all while letting it get pulled down, they make their passive fixed income. Hedge funds and such can do their aggressive moves and get more aggressive returns. But this is all shit nobody wants to talk about or listen to. I've been talking about it for over a year. So, and that's why interest rates are so important, is because those APRs, those borrow costs, whatever it is, all have to remain in sync with what Treasury notes are doing. I mean, that's the foundation of the US dollar. And so when interest rates go up, you know, the vice on those who are borrowing securities tightens because the lendee will be increasing those rates. But at the same time, the value of the stock market will decrease because when bonds go up, the market goes down because bonds are a safer avenue. And as you get safer returns on an already safe instrument, that means that you will pull it out of growth and put it into value, which you could do with Coca-Cola or you could do with fucking T-notes. So, you know, there's a myriad of reasons for what you can surmise all this to. But again, no one wants to listen to it. With all that being said, you talk about cycles. Here's your fucking cycle. It's been something I've always been trying to get people to listen to, and nobody would listen. What does this mean that the synthetic shares will not receive the special dividend? I mean, that's what we're trying to see about GameStop, and GameStop hasn't done anything. TLDR, fresh liquidity that custodians can purchase will inflate stock prices so that they can then lend those shares out to aggressive hedge funds to short sell to the way down. The hedge funds collect their delta. The money market fund, the pension fund, collects their interest. Cycle goes around. It's clockwork. So, you know, I hope to see what I just said be plastered all over Reddit so people learn. Probably won't happen. Yes, a short squeeze is a technical play, but technicals cannot define fundamentals. Fundamentals being things like interest rates.